Good afternoon, everybody. Welcome to Liberty Call. Today is Tuesday, September 19th, 2023. As you can see, my head of security is back here on the job. Jake is actually heard my wife walk out of her office, so he's very interested in what's going on the other side of that door over there. So anyways, not the greatest day in the markets. Lots of red here domestically. Let's scroll through the rest of the globe. Some green, but not great, unfortunately. Most folks, like I said yesterday, are kind of on pins and needles. What's the Fed going to do? They're meeting today, and then they're also going to have their second day of meetings tomorrow, and then they'll announce, are they going to raise rates? Are they going to, keep them where they're at and wait and see where the data tells them to go? I don't know. I'm kind of 50-50 on it. I know most of the, prognosticators out there and, the financial journalists seem to think that, we're the rates have stopped. I know I've covered a few articles that, the smart people seem to think that we're already at the, terminal limit of interest rates. Personally, I think they should go higher, but, what do I know? Anyways, all right. If it's your first time watching Liberty Call, I'm glad you're here. Thank you very much. If you could do me a favor, give me some thumbs up, likes, shares, subscribes, follows, press the notification bell so you know when I go live. And let's go ahead and jump into the data for today. All right. Dow Jones was down 0.31%, 106 points, closed at 34,517. S&P 500 was down 0.21%, closed at 4443. NASDAQ was down 0.23%, closed at 13,678. The VIX was up 0.79% today. It's currently at 1411. Canada down 1.34%. Brazil down 0.39%. Mexico up 0.95%. Over in Europe, Germany was down 0.4%. The UK was up 0.09%. France up 0.08%. So they're basically both flat for today. The Netherlands was down 0.13%. Spain up 0.4%. Italy up 0.6%. Switzerland down 0.2%. And Portugal up 0.45%. Russian exchanges, MOEX down 1.64%. RTSI down 2.07%. And the overnights, the Nikkei in Japan was down 0.8%, Australia down 0.47%, New Zealand down 0.29%. In China, the Shanghai was flat at down 0.03%, the Shenzhen Component down 0.73%, China A50 up 0.02%, so basically flat. DJ Shanghai down down 0.16%, Hang Seng up 0.27%, and the Taiwan weighted down 0.37% for the day. So, like I said, kind of just everyone's sitting around, frantically worried about what the Fed's going to do. Are they going to raise rates more? Which, oh my God, that's going to crush the economy. I mean, frankly, if you didn't print all that money 3 summers ago, we probably wouldn't have had to raise rates like this. I mean, granted, rates were held at zero basically during the entire Obama administration, but they were starting to creep up during the Trump years. But they even dropped rates in 2019 because the economy was starting to get a little shaky. And I'm sure Trump and his cohorts are putting pressure on the Fed to keep, the economy good to go through 2020. And we know how that turned out. All right. Market recap. S&P 500 wobbles as Treasury yields advance ahead of Fed decision. All right. On Tuesday, the S&P 500 experienced a slight decline, primarily influenced by surging Treasury yields and a cautious sentiment prevailing on Wall Street ahead of the upcoming Federal Reserve monetary policy update scheduled for tomorrow afternoon. Treasury yields continue to rise, with the 2-year and 10-year yields approaching their highest levels since 2006 and 2007, respectively. This increase in yields was fueled by concerns over inflation, particularly following the recent surge in oil prices, which has not helped inflation at all. The Federal Reserve commenced its 2-day meeting, widely expected to conclude with unchanged interest rate decision. However, investors are closely watching the updated summary of economic projections accompanying the decision, as Deutsche Bank suggests it may undergo meaningful revisions, and that's in quotes. These projections are likely to reflect upgrades in economic growth and labor market conditions, with a potential downward revision to inflation, particularly for 2023. The UAW union issued a warning stating that it would expand strikes at car manufacturing plants across Detroit's major automakers, including Ford, GM, and Stellantis, if significant progress, and that's in quotes, in negotiations isn't made by Friday at noon. The strike, which began on Friday after the union rejected an automaker proposed labor deal, are now in their 5th day. Oh my God, what are we going to do without cars for 5 days? Amazon announced plans to hire 250,000 workers in the U.S. in preparation for the holiday shopping season, aiming to meet the surge in demand that typically accompanies this period. Well, unless we're in some sort of horrible civil war / recession, but hey. Disney revealed its intent to nearly double its investment in Disney parks, experiences, and products over the next decade, allocating approximately $60 billion. The substantial investment will focus on expanding theme park space with over 1,000 acres of land available for development. Yeah, but it's in Florida and it's so hot. Oh, I mean, even in January, it's sweaty down there. Instacart made an impressive debut on the stock market with shares opening at $42 on the NASDAQ, a 40% increase from its IPO price of $30 per share. While the stock saw some fluctuations, it ultimately traded about 21% higher. Despite oil prices remaining above $90 a barrel and the expectation of a continued rise due to crude supply deficit, energy stocks slipped more than 1%. Companies like Chevron, ExxonMobil, and Marathon Oil were among the major decliners in the energy sector. In summary, rising Treasury yields, anticipation of the Federal Reserve's decision, labor disputes in the auto industry, holiday hiring by Amazon, significant investments by Disney, a successful stock market debut by Instacart, and fluctuations in energy stocks all contributed to the dynamics of today's market. Exciting stuff, I know. That was a mouthful. So Disney's going to spend some money. I mean, I don't know how that's going to affect their share price. I mean, maybe down the road, but in the short term, I don't know if that's going to really put a lot of upward trend. And especially, with if we do go through some sort of a downturn, which, I'd put it probably closer to 70%, are people going to be going to Disney a lot over the next couple of months or years? I don't know. I've never been personally. Well, I've been to Disneyland. I've never been to Disney World. All right, next up, U.S. housing starts hit 3-year low. Surge in permits point to underlying strength. All right. U.S. home building experienced a significant decline in August, hitting a more than 3-year low. This drop was primarily attributed to the resurgence in mortgage rates, which weighed on housing demand. However, a notable increase in building permits suggested that new construction remained supported due to a shortage of homes in the market. The decline in housing starts, as reported by the Commerce Department, marked the largest in a year and was a widespread phenomenon across various sectors. This followed a report from the previous day indicating that homebuilder confidence had declined to a 5-month low in September, with more builders resorting to price cuts and incentives to attract buyers. Housing starts dropped by 11.3% in August, reaching a seasonally adjusted annual rate of 1.283 million units. This was the lowest level since June of 20. Additionally, July's data was revised downward to show an acceleration in starts, reaching a rate of 1.447 million units. The single-family housing starts, which represent the majority of home building, declined by 4.3% to a rate of 941,000 units in August. While this segment rose in the South, it fell in the Northeast and Midwest, with a significant decline of 26.9% in the West, partly attributed to Hurricane Hilary. Despite the decline, demand for new construction has been robust due to a shortage of previously owned homes available for sale. However, the recent surge in mortgage rates, coupled with higher U.S. Treasury yields, has led potential buyers to adopt a more cautious approach. The average rate for a 30-year fixed mortgage is currently around 7.18%, the highest since March of 2002. With the Federal Reserve while the Federal Reserve is expected to keep interest rates unchanged in its upcoming decision, the housing sector has been sensitive to the central bank's aggressive monetary policy tightening, with multiple rate hikes since March of last year. Building permits for future home construction surged by 6.9% to reach a rate of 1.543 million units in August, the highest since October of last year. This increase was driven by a significant 14.8% surge in multifamily housing permits and a 2% rise in single-family housing permits. Despite the slump in home building in August, economists anticipate a reversal of this trend in September. The backlog of houses approved for construction but not yet started increased, indicating potential future activity. Housing completions declined, but there is a backlog of single-family homes under construction, suggesting growth opportunities for home builders, especially in the entry-level home segment. In conclusion, the U.S. housing market faced a significant decline in home building in August, primarily primarily due to rising mortgage rates, but the sector remains supported by strong demand and a backlog of permits. The impact of these dynamics on the broader economy will continue to be closely monitored, I'm sure by very smart people. All right, last up, got an article here from Mises Wire titled "A Ticking Time Bomb, a Huge National Debt Plus Rising Interest Rates." That sounds positive. All right, while the U.S. has seen a continuation of economic growth with a GDP increase of 2.1% in Q2 and low unemployment rate of 3.8% in August of this year, there are numerous factors hinting at potential economic challenges. High inflation has eroded real incomes for both individuals and businesses, dampening demand for goods and services. Rising credit costs initiated by the Federal Reserve's interest rate hikes are expected to slow down consumption and investment, potentially leading to more loan defaults. Additionally, the inverted U.S. yield curve is signaling a looming recession. The increase in yields has also put downward pressure on asset prices, particularly in real estate, impacting banks and making them more cautious about assuming additional credit risks. Consequently, the supply of borrowable funds to consumers and businesses has shrunk and become more expensive compared to the ample and affordable credit supplies of the past decade. The decline in bank lending growth, down 0.5% year over year in August, has also affected the money stock M2, which decreased by 3.7% year over year in July. However, it's important to consider that the, quote, time factor, the impact of higher credit and capital costs tends to manifest gradually over time as borrowers have varying debt maturity profiles. Only a portion of the firm's loan portfolio will face higher interest rates in 23. But over time, credit costs rise as more outstanding debt needs refinancing at higher rates. This can lead to reduced profits for firms and decreased demand for their products and services, eventually causing economic slowdown or contraction. In response, the government may increase its deficit to stimulate demand and counteract recession. But this approach is risky when government debt is already high and borrowing costs are elevated. Investors may lose confidence in the effectiveness of such deficit spending, potentially leading to severe consequences. Despite the premature predictions of a recession and stock market crash, there are concerns about valuation levels. The rise in interest rates has already significantly impacted various asset markets, including real estate. Asset price reevaluation may not have reached its final stage, and questions about the direction of interest rates persist. Regardless of the future path of interest rates, holding physical gold and silver is seen as a prudent move. Higher rates could trigger a large-scale credit event, while declining yields may signal a return to inflationary monetary policies aimed at boosting asset prices and overcoming economic challenges. In summary, while the U.S. economy has been resilient, there are factors suggesting potential headwinds ahead, making assets like gold and silver attractive hedges against economic uncertainty and potential future storms, including recession, high unemployment, and persistent goods price inflation if central banks resort to further monetary easing, which what that means in English, money printing. If they go back to that, wait for more inflation. I mean, it may not happen immediately. It didn't happen 3 years ago when they first printed all that money and dumped it into the economy. It took a year or two to really start to show its ugly face. But again, I could be completely off base. The Fed could have done totally enough, getting rates up to 5.5, wherever they're at today, and then maybe that squashed the inflation completely. I could be completely off base, but historically, I just don't think that's going to happen. So. All right. Well, that's everything I had for today. If anyone needs anything from me, if you would go to dsafinancialgroup.com, all my contact information is there. I hope you have a wonderful evening, and I will talk to you guys next time. Adios.